Welcome, everybody, from Integrity Wealth Advisors downtown studio. Welcome to our town hall for February. Got some interesting stuff to talk about this afternoon, and we're very grateful that you've joined us. As you can see, I have my sweater on. The weather's turning. We've had some rain, and I guess there's more coming in the forecast. So we're going to cozy up together, talk about the markets, and get into our agenda. So let's do that right now. All right, I've got some new technology here. There we go. All right, so we're going to look at this month's agenda. We'll look at the returns of the market so far this year. There's some interesting gains in the markets that I think are going to, support some of the things that we've been talking about in terms of where to be invested in 2026 and beyond. We're going to talk about the January effect. You may have heard of this, you may not have. We're going to talk about the new Fed chair and introduce him to you and what effect he might have on our financial markets going forward. We're going to look at a nice slide. It's a single slide that is going to have market pros and market cons. And then we're going to talk about some housekeeping thoughts going forward with regard to these town halls. And then, of course, if you have any questions, please feel free to type them into the chat room. Or if you're super brave, just raise your hand. And Gavin will make sure, my trusty sidekick here, he'll make sure that your question gets asked. Okay? All right, so let's get into the market so far through today, actually through yesterday. S&P is up 1.5% so far this year. That's actually pretty darn good. But as you know, we're digging well beneath the S&P 500. And we've been talking about something called the equal weight 500. And take a look at that number. It's up 6% so far this year. That's a 3x, 4x return over the S&P 500. So what is the equal weight? Just as a reminder, the S&P 500 is something called a cap-weighted index, meaning there's 500 stocks, but they don't all register the same way. If you're Apple, Microsoft, Amazon, or one of the other gigantic behemoths, also known as the Mag 7, if you're up or down in a day, you have a much greater impact than, say, a smaller member of the S&P 500, say like a Pfizer or Bank of America or Procter & Gamble does. But what the equal weight 500 does is equal weight every one of the 500 names. And so why is that valuable? Well, it helps tell the health of the index. So the last 2 or 3 years, you had just the Mag 7, Google, Apple, Microsoft, Amazon, Tesla, etc., going up enormously and making up most of the gains of the index. In fact, in 23 and 24, the market was up 20 and 24% respectively. But if you took out the Mag 7 from the S&P 500, the stock market was up 0 in those 2 years. And so you can see that it was overly dominated by just 7 or 8 companies. And really, we feel that's very unhealthy. We think it's much healthier when the stock market is going up, that participation by a lot more than 7 names is very, very healthy. And we'll talk about the reasons behind that and why we are very optimistic about the market going forward the rest of this year and probably well into 2027. Now, outside the borders of the U.S., you might be surprised at this as well. Take a look at that. This is the International Stock Market Index just for the first, 6 weeks of the year, up almost 9%. That's really astounding. And that's on the back of a 30% gain last year versus our 17% for the S&P 500. And then where we're also really bullish this year is in smaller companies, represented here by the Russell 2000 Small Cap Index. It's up 8% so far this year. So the stock market, as you can see, is acting very, very healthy. We have not seen this kind of broad market move in the markets for several years. Again, as we mentioned, the S&P 500 was basically dominated by the Mag 7. Small cap and international and every other stock index, for the most part, trailed the S&P 500. And now we're seeing the complete opposite, and that is a very, very healthy sign. Now, we also follow the bond index, so for safer investments, folks that are interested more in income than they are growth, you're having another reasonably good start to the year. The The bond index is up 0.76% for 2026, which is certainly very, very good for a safe investment asset, particularly when things like money market accounts and CDs, you've seen those rates come down over the last several months as the Fed cut short-term interest rates. So that's bad for CDs and bad for savings accounts and money market accounts, but it's really good for bonds, and obviously the numbers are reflecting that. All right, let's go into the January effect. Now, these were supposed to come in one at a time, but they didn't, but that's okay. We're going to talk about this January effect. Positive Januaries are followed by up years 89.1% of the time. That's 41 out of 46 years studied here. And also, too, when you add to this the first 5 days of January are up, which they were the first 5 days of January 2026, then the average return going forward in those 46 years was almost 17%. I mean, that's pretty astounding. I typically don't like these kinds of barometers, but when you have a win rate, a success rate to the extent that the January effect does, it's pretty hard to ignore. Now, we're going to be talking about midterm election years a little bit later in our town hall today, and you're going to want to stay tuned for that. So I did want to throw in that when January is positive in midterm years, you're getting an average of 15.4%. That's 6 out of 9 years. The reason we're talking about this is because midterm years are traditionally pretty volatile, pretty rough for the S&P 500. We think this year will be different, but nonetheless, it's important for you to see what we're going to be talking about there. This January effect also is this barometer shows up very much so in smaller names. So obviously this 89.1% of the time that we referred and the 16.9% average return, that's for the S&P 500. Those are large mega cap style companies. But if you look just at small caps, the results are even better. And we're seeing that so far. Small cap index up 8% versus 1.5% for the S&P 500. Now, none of this is a guarantee, but certainly a historical trend. All right, now, a couple of weeks ago, in fact, 2 weeks ago, Friday, a gentleman by the name of Kevin Warsh was announced as the new Fed chairman, and the markets abruptly decided to go down. So who is this guy? Well, he was a surprise pick. Nobody thought it was going to be him a few months ago. But I've got an anecdote on that for you. He's the youngest Fed governor ever. So as you know, there are Federal Reserve banks all over the country. There's one in L.A., in San Francisco, in Atlanta, New York, Boston, Philadelphia, Chicago, etc. And he was the youngest Fed chairman, or Fed governor, not chairman, but Fed governor of one of the Federal Reserve banks ever. So why is that important? I think it's really important because he's got a lot of experience in dealing with the Fed and with the Fed chairman and his fellow Fed governors. We think that's important. And looking back and studying his history, he's in his mid-50s right now, but if you go back 17, 18 years to 2008, that was a significant crisis. That was probably the only time in recent memory where the stock market and the economy was seriously in danger of slipping into a 1929 style depression. And so he played a key role in that regard. He was like the main liaison between the Fed and representatives of Wall Street. So he was one of those middlemen at a very young age, in his 30s, but played a crucial role. So that experience of dealing with an emergency national financial near disaster, we think is amazing, and we think that will help him through any tough times that he may well have to go through as Fed chairman now. Now, he's definitely in favor of reducing short-term interest rates. I don't think that's a surprise to anybody. I don't think the current president was going to choose anyone that was anti cutting rates. So whoever got chosen, it was going to cut rates. Now, what's interesting is you may remember 2 Fridays ago when he was chosen, the market sold off. Risk assets sold off. Bitcoin got crushed. Gold and silver, which had rallied unbelievably over the last year and a half, gold was down 10% that day, and silver was down an astounding 30% that day. I don't think it's a coincidence that all of these assets were down as a result of his nomination. Why? Because while he's for cutting short-term interest rates, he is not for something called quantitative easing, or QE. What is QE? Well, as you see in that bullet point there, he's against big asset purchases. So going back to 2008, one of the things the Fed did right away is they cut rates to zero, but they also went out into the open market and purchased bonds. Same thing during COVID, except to a much greater extent. During COVID, the Fed cut rates back to zero. And then they embarked on an unbelievable buying frenzy where the U.S. central bank's, Federal Reserve Bank went out and in the open market purchased short-term, medium-term treasury bonds, as well as mortgage-backed securities. It's one of the reasons why mortgage rates, 10-year rates, went all the way down into the mid-twos during that whole period of time. And you actually saw housing values go up during a national disaster like COVID. You would think everything would implode, and it didn't. Why? Because the government was in there supporting the system. And so what happened is that they had all these assets that they bought. Now they had this gigantic balance sheet. So for the last year and a half, 2 years, they've been rolling those off. They've been selling them into the open market. As they mature, they've been letting them just mature, and that's the end of it. He is likely going to stop that. He will certainly not be pro supporting financial market prices by going in and buying assets in the open market. Now, this is not something that you hear about every day. You always hear about the Fed cutting rates or raising rates. You don't hear about their balance sheet. But this is the reason why the market cratered. Now, it's interesting. The market was down that Friday, and then Monday, Tuesday, Wednesday, Thursday. It was a weak sell-off, a full week sell-off, W-E-E-K. It was a strong sell-off, not a W-E-A-K sell-off. But then Friday, it went through the roof. I think what happened was the market adjusted to this new guy, realized that the economy is good, and we're going to be talking about that today. And look, he's still going to be lowering rates. You've got great corporate earnings out there. So, it was a little bit of market turbulence that has corrected itself, and now we're just right there, 1% or so beneath all-time highs in the market. So we're excited about him. We think he's going to be good. And I'll tell you a quick anecdote. I was at a conference down in San Diego last August, and one of the speakers was an economist by the name of Jeremy Siegel, Dr. Siegel, professor at Wharton. And it was interesting. He got up there. This was back in August, so a long time ago. And he said, look, the guy that I think that should be the Fed chairman will not be nominated as the Fed chairman, but he should be. And he went on to go through all of the attributes of this Fed chairman that he felt should be the Fed chairman. And guess what? It was Kevin Warsh. So that's that made me feel good, because this is an economist that I followed for years and years and years and years. He's one of the best, if not the best, out there. And he was espousing, promoting Kevin Warsh way back in August when nobody was talking about him. So good for him, and I think good for the Fed, and good for the rest of us as investors. While this guy's not going to try to fuel speculative frenzies, he certainly will promote lower rates as needed and support the economy in that way. And obviously, this economy we think is going to do really well going forward, and we'll talk about the reasons why. All right, so let's do that right now. Let's talk about our take on the economy and the markets in 2026. So we've got pros and cons. I think that's fair to do. So let's get into the market pros. As we just talked about, the Fed is lowering rates in a growing economy. We think that's a fantastic combination. You think about it, typically, when does the Fed lower rates? Usually, it's when there's some financial emergency or collapse in the general economy. Consumers aren't spending anymore, or the unemployment rate has gone up massively, and they need to lower rates to try to spur borrowing and spending. It's unusual for the Fed to be lowering rates in a growing economy. We've got a slide later that we're going to be sharing with you in that regard. This year, you're very likely, if you make less than $150,000, and that's most of America, you are likely going to see significantly higher refunds. That's because of the no tax on tips, no tax on overtime. For those of us that are 65 years of age or older, an additional $6,000 deduction over and above the standard deduction. All of this is going to create higher refunds. Oxford Economics estimates $93 billion in additional refunds. And what do you think the average person's going to do with their refund? Do you think they're going to come in here and invest it with me? I don't think so. I don't think they're going to pay off bills. I think they're going to go out there and spend the money, and that's going to really help juice the economy. So that's a huge win. You've also got the 100% immediate deduction for business purchases. If you're a small business owner or a large business owner, you go out and buy a building, a car, or a piece of machinery, prior to the tax bill that got passed last year, you could write that off, that asset purchase, that machine, say. Let's say the machine costs $100,000. You could write that off usually over a period of 6 to 7 to 8 years in the form of depreciation. So 1/6 every year for 6 years. Guess what? Now you can fully expense that in year one. So you go out there and buy that piece of machinery, even if you're borrowing to go buy that piece of machinery, you get to write the whole darn thing off in year one. So do you think that's going to incentivize businesses that were on the fence, for example, to buy some equipment for their firm, to get off the fence? We think it will. And this is very, very bullish for the economy and for economic growth. We look at other factors such as unemployment. So if people are secure in their jobs, they're getting normal raises every year, that's a consumer, that's a healthy consumer. That's a consumer that's not going to put off planning a trip, shopping on Amazon, buying the new car, etc. So with unemployment still low, that's a huge pro for this economy. Unemployment at 4.4%, that's historically low. Anything under 5% is considered full employment. And then, of course, we've got consumer spending, not surprisingly, at an all-time high. Corporate profits are at an all-time high, and they're expected to rise double digits this year again. And as you know, as clients and students of ours, that the stock market follows corporate profits. It doesn't get any more complex than that. That's certainly a pro. And then last but not least, artificial intelligence, also known as AI, is starting to create real and measurable results. Yes, you are hearing about job displacement, and you will hear more about that going forward. A lot of white-collar workers, middle managers, very much in danger of losing their positions as AI is used to basically make the decisions they were making before and reduce the number of people involved. So this is obviously short-term bad for some workers, but when you look at it from a global standpoint, tremendous belt-tightening item for a corporation. Obviously, if they're able to save money, that's higher corporate profits, more efficiency, more productivity, and we're seeing that in a measurable way right now. And it's one of the reasons why you're seeing corporate profits really start to take off here. And so these are all the market pros. There are others, but these are the ones that we see as most important in terms of directly affecting the economy and therefore the stock market. So what about the cons? Well, they are there. And look, I made this slide about a month ago. So this was before 2 Fridays ago when tech started to get wrecked. One of the cons was high tech valuations. And one could argue that a lot of the tech valuations are still really high. And so, anytime you have a tech valuation of whether it's Amazon or Microsoft or Apple or whoever, if they don't toe the line just perfectly when they come out with their earnings report, they're susceptible to big sell-offs in the aftermarket. I mean, Amazon was a good example a few nights ago. They were down 10% after a decent earnings report, but saying that, hey, they're going to spend an additional $200 billion in capital spending, investment into AI. And, of course, the market was in a nervous mood and took that as a big negative. How can they be spending all this money? Is this really making sense? And they sold the stock off in after hours by 10%. So that is definitely a con. It is something that we as investors need to be concerned about. Gross domestic product, or GDP, most economists have this declining from 3.2% in 2025 to 2.9% in 2026. Interestingly enough, there's a website out there called GDP Now. So gdpnow.org. Go there. That's the Atlanta Fed, and they basically make a specialty of tracking what's going on in the GDP in real time. And if you go there, you're going to see that they're expecting GDP to wind up at a higher level than what these economists are projecting. And a lot of it has to do with AI spending. But let's just set that aside. Even if these numbers here are real and we have a decline in GDP from 3.2 to 2.9, for an economy of the size of the United States of America, 32 trillion and counting, that's a really good growth rate. But it's still technically a con when you consider that it is expected to decline this year. And of course, we all know national debt at record levels and rising. Consumer confidence, for example, as well, is at its lowest number ever. Every month, the University of Michigan does a survey, and wow, I mean, it's at the lowest it's ever been. And we're talking, 30, 40 years of doing these surveys, and so that's not good at all. And then, of course, the aforementioned new Fed chairman, that's a con too, because remember, he's not going to be for that QE, that quantitative easing, that going into the system if there's a problem and just buying bonds in the open market, providing somewhat of an artificial support for rates. So that is a con, and that is something that we need to be aware of. And then finally, the other big con, and we talked about this a little bit in our intro, is the midterm election year con. So what are we talking about there? Well, let's see here. We've got first we'll talk about our strategy here for the year. In 2026, our investment strategy is that the other 493 should do well. So we talked about that equal weight 500. That basically accentuates the other 493. Now, the position we use is only about 77 stocks. They're all large companies. They all pay dividends, and they have all raised their dividends, and that is doing very, very well, outperforming the S&P by a significant margin. Smaller companies are poised for this environment too, and you've seen the results so far. We've been talking about this for many, many months. If you've been tuning into our town hall, our view is when the Fed begins to cut rates and the economy starts to expand as it is, small companies are the biggest beneficiaries of that. And then, of course, bonds should do well. They did well last year as a group. They were up 7 or 8% last year. This year they should be up close to that again as the Fed continues to lower rates. And we think this could be a repeat of 1995. Some of you are saying, 1995? What century is this guy in? Well, I remember 1995. I was just a 35-year-old kid. But I do remember it like it was yesterday. 1995 was a year very similar to what we are seeing right now, where the Fed is cutting rates, but the economy is expanding. Let's take a look at what I'm talking about here. So you've got two colorful lines here. The purple line is the Fed funds rate. So you can see here, starting right here in 1995, the Fed cutting rates. The orange is the S&P 500. So as the Fed cut rates, what did the market do? Well, the market went up. When the Fed paused, the market continued to go up. When the Fed raised a little bit, the market went down, as you can see. And then when they paused, the market continued to go right back up again. And then in late 1998, Russia devalued its currency. Big problems internationally. There was a big decline in the S&P 500, and so the Fed cut rates a couple of times, quite a bit actually, and then the market responded by moving up. So you can see the correlation between the Fed lowering or raising rates and the corresponding movement in the market. Now, what else is interesting about 1995? Most of us who were around remember that that was really the time of our history where the internet was just being introduced. It was just taking off. Remember, you'd walk into Staples and you'd be in the checkout line and there'd be a box on the wall and it was called Internet in a Box. I mean, you had to plug it into your phone line in the wall at home. That was the dial-up internet days. Well, that was a time of incredible innovation because we had this new thing called the World Wide Web, the internet. And the economy was expanding. There was tons of money being invested into laying cable and everything else for the bandwidth that this newfangled thing called the internet required. And yet, inflation was low. And that's why the Fed was able to lower rates. Ladies and gentlemen, we are in the same situation today where we have unbelievable innovation, incredible spending, and I would argue much more healthy spending, because back in the mid-90s, these firms were going out borrowing money, leveraging themselves immensely in order to make this internet investment. Well, today you've got companies like Google and Microsoft and Amazon that are using a lot of their cash, operating earnings. And they are doing some bond issuance, so they are borrowing some money. But we're not seeing the leverage anywhere near to the extent that it was back in the mid-90s during that period of economic expansion. So, again, the correlations here are pretty amazing. I'm not saying that we're going to repeat this, but Mark Twain was famous for saying history may not repeat itself, but it rhymes. I think it's going to rhyme. I think we're going to have a very similar period in the markets where you've got a Fed that's cutting, an economy that's expanding, and you don't have inflation with that. You have high prices, but those high prices are not going up to the extent that they were a few years ago. They're going up minimally now on average. Okay, so that's really, really good news, and we thought that you would really enjoy this this slide. All right, now let's talk about that midterm drawdown. So getting on to the con side of things, here's a chart that goes back, from 2022 all the way back to 1950. And what you're seeing here is every single midterm market year, you're seeing the drawdown or loss in the markets from January 1 of that midterm year all the way up to that first November or that first Tuesday in November. Excuse me. And how poorly the market did, how much the market fell during that period of time. So if you go back there to 1950, what was the market down? It was down 12% from January 1st through the midterm. Some of these numbers are huge. I mean, here's a 26% drawdown, a 20, a 25, and a 35. The last midterm was 2022, and you can see the market was down 24%. So, again, volatility is associated with midterm election years. People don't know who's going to win, who's going to lose. There's uncertainty. Anytime there's a level of uncertainty in the markets beyond what is normal, the market sometimes can overreact to the downside. But look at what happens 12 months after the midterm. That's represented by these blue bars. I mean, look at the returns. You can see that the max drawdown averages about 16%, but the 1 year after midterm election year average is over 18%. So, it will be a time not for panic, but it will be a time to stay the course. It will be a time to even hold your nose and pull some money out of your wallet and buy something if we do have a big downturn. Now, I think we do need to decipher this a little bit. So if you were to go back to 2022, why was the market down 24.5%? Do you know the answer? Was it solely because of the uncertainty of a midterm election year? If we go back to 2002, was this 33% drawdown solely as a result of the midterm year? I would say the answer is no. So 2022, we all remember what was happening back then. The Federal Reserve Chairman, Mr. Powell, remember, he was raising rates. He should have been raising rates in 2021. He didn't. He waited, and then inflation, was a wild horse out of the barn, and had to raise rates egregiously fast, the most rapid pace ever in Fed history in terms of raising rates from a percentage standpoint. And so, when the Fed is raising rates that quickly, the market's going to get crushed, and that's exactly what happened. So it wasn't just because it was a midterm election year. 2002, very similar scenario, but not inflation. It wasn't the Fed raising rates. That was, remember, the now infamous Enron fiasco, where U.S. corporations, it was a worry that Enron was viewed as this belle of the ball, this incredible company that was like the top of the heap, and everybody was investing in it, and it turned out to be a complete fraud. And so the fear through Wall Street was, wow, are other corporate financials fraudulent? And you can see them just got crushed. At one point down over 30%. And of course that turned out not to be true. The average corporate board of directors and executive wing are very honest, hardworking men and women, but nonetheless it shows how fear can find its way into the markets and cause a lot of pain. So it's not just because it's a midterm year. There are other factors. I'm not sure this year we're going to have those other factors. You're not going to have a Fed raising rates. I don't think we're going to have any kind of corporate malfeasance where we have to worry about the honesty of the CEO and CFO. So it very well could be a market drawdown like it is here, or maybe the 7.5% that it was in 2006. Needless to say, there will be a drawdown, and we just need to be patient. And as I said, even stay the course or hold your nose and buy some things on the cheap. Okay. Nonetheless, this is a great saying to remember. Don't try to time the market. This is Peter Lynch, one of the greatest mutual fund managers ever. He says, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And how true that is. I can't tell you how many times I've had somebody call me up and say, hey, Steve, and this is, of course, after the market is down. They'll say, hey, Steve, don't you think we should maybe pull some money out or pull the money out and just set it aside in something safe until it's safe to go back into the stock market? Well, I mean, how do you answer that question? I mean, that's a tough one to answer. The answer is you don't try to time the market. And this slide here is a great reminder of that. Staying invested. What happens if you miss the best days? I mean, oh yeah, we're going to get my money out and then we're going to get back in when it's safe. Well, here's a nice little chart of $1,000 invested over the last 25 years in the S&P 500. What you would have earned on that. So fully invested, not trying to time the market, look at your total return. That $1,000 would have turned into $6,000, 6x. But if you would have missed just the one best day, look what happens to your returns. What about the 5 best days? Now you've got severe losses in what you could have had. Your average annual rates of return go from good to just mediocre. And I would argue it would be very hard to time it where you would just miss even the 5 best days. It's more than likely you're going to be over here in this category right here, where you're going to miss even more of the best days. And so again, we're so blessed, aren't we, to have history? I mean, imagine if we were investing 100 years ago. You wouldn't have the history. You certainly wouldn't have Zoom, okay? But you wouldn't have the history to go in and look at market behavior and what actually occurred. We're so fortunate to have that, aren't we? And we're very privileged to bring you this information, to give you the confidence to hang in there. And yet we know that if you can't, that's what I'm here for. That's what Lainey is here for, and Doug is here for, and our wonderful staff is here for. So again, we think this could be a repeat of 1995, and as we just discussed in those couple of slides there, that you got to maintain discipline, rebalance as the year goes along. We're going to do that, and we will be, as you know, we will be alert for opportunities on these pullbacks. As you know, we've got our model portfolios, we've got our favorite individual names, stock names in there, ETFs and mutual funds. You know what we've done in the past. We'll continue to do it for you in the present and future when we have these kinds of turn downs. And as I mentioned, our staff is wonderful. They're here for you. Don't be bashful to call up and request a meeting with me or Lainey or Doug or any other issue that needs attending to in your portfolio and your financial plan. And so with that, I want to thank you for taking time out of your busy schedules to join me this afternoon, and we hope that you are all healthy and stay dry as these rains come. Any questions, Gavin?
No questions.
All right. Fantastic. All right. Well, look, enjoy your evenings and afternoon with you and your families and other loved ones. And until next time, we'll look forward to it. Bye-bye now.